Hello and welcome to this video on selling your business. It's designed to accompany the ebook of the same name. If you haven't already downloaded that, you can get it at the website www.nickbettis.co.uk. Like most business owners, you probably want to realize some money when you finally exit and sell your business. You'll be looking for a reward for all the hard work you've undoubtedly had to put into it over the years. You don't want to be one of those business owners who, because you don't prepare properly to sell their business, either make far less money than they should do or in fact fail to sell it at all. It's worth remembering that the same things that make a business attractive to a buyer make it a good business for you to own and run. So bear that in mind while you watch this video, which, whilst it's about selling your business, should also prompt you with some ideas of things you can change right now. Here are some typical motives for selling. Often people get to the point where they don't want to invest any more money in the business, or perhaps they've got other things they want to do with their time. Or sometimes, as the last point says, someone else comes along and makes an offer. The problem with that last reason is that it means you're not controlling the timing, which is one of the 6 things you need to do to get the best price. We're going to talk about the others in more detail now, but essentially to minimize risks, generate competition and look outside your industry, and to sell something that's about the future for the acquirer rather than the numbers that you've managed to produce with the business. Finally, you need to get your business in shape, and that doesn't take weeks or months, it takes years. So for most of us that means starting to think about it right now. So minimize risk. This could typically be over-reliance on a single customer or supplier or some key employees. It might mean you've got no formal contracts that lock your customers into recurring revenue should you sell the business, and there may be in some cases some skeletons in the closet in terms of potential litigation. Controlling the timing means selling it when you've had a few years of profitable growth. People are reluctant to buy loss-making businesses. So you're not engaging in a financial transaction when you sell your business, or not wholly a financial transaction. It's primarily sales and marketing. And if you think about it, a business owner's role is really not to make and sell widgets, but it's to make and sell a business, and that's what you should be spending your time thinking about. If you can generate some competition in terms of bidders, then the price will go up. It's the same as any other market. Sometimes that means looking outside your industry for people who can create what's called strategic synergies when they put your business together with their existing business. So don't get trapped into providing a price which is based on the latest set of figures. If you sell a horse in a horse auction, all you're going to get is what the horses go for. Really, you need to be selling a vision to potential buyers of the revenue streams that they could generate once they own your horse. So these strategic synergies, so-called, fall into various types. So the kind of things you could be looking to set up as your vision, as the way you want to exit the business, the synergy that you're looking for a buyer to acquire, could be geographical. So if you're in the south and you know someone in the north would like to make an entry into the south, then that's going to add value to your business. Or if you're in Britain and you think someone in China might like to be able to do what you do in Britain, then that also adds value to the business. Approvals and licenses, these are difficult and time consuming to acquire. If you've already got them, someone buys your business, then they inherit those approvals and licenses in most cases. So this also has value. And clearly access to customers and a sales force is valuable on both sides. So each side can put their existing products through those channels. Economies of scale are not exactly synergies, but if you can double the size of the business but still retain the same back office function and cost, then clearly that's delivering additional profit. Barrier assets are a bit like the licensing and gives you access to a market. Perhaps if you know, it could be a banking license or a factory or a particular process or a fleet of vehicles, things that are quite expensive to get hold of otherwise, so known as barrier assets. And diversifying risk is also a reason that someone might think it's useful to acquire you. If they're got a very cyclical business or only a small number of customers, then that would be a reason. Our friends at BCMS say that taking this strategic view can generate up to 2.5 times the base value of the business, so certainly worth paying some attention to this. So here's the process, very simplistically on one slide. Preparation, I'm not talking about a few days or weeks or months here, we're probably talking about years of preparation to get the business fit for sale and positioned properly so that your strategic acquirer can see the value. So let's assume you've spent some time getting that business straight. Then the thing really kicks off with selecting a business broker. A broker will have the negotiation techniques, the contacts, the methodology, the databases, A, to do this properly, and B, to save you devoting all your time to trying to sell a business as opposed to keeping the thing running. So you really should use a professional broker with a track record of selling businesses like yours. That broker will profile and research, so they'll have this kind of discussion with you about who might buy your business and why, and they'll go out and look for those people. They'll issue a prospectus, which is like a little advertising blurb for your business with no sort of names or numbers on it. Then out of that, they'll generate some prospects they think might be good acquirers, approach them, hopefully get some non-disclosures and offers in place from a few of those, and select a preferred bidder. Due diligence is getting towards the end, and due diligence is where, if you haven't prepared your business properly, if there are skeletons in the closet or risks or things that aren't working as they should do, it will become apparent to the buyer at this point, and they won't buy your business or they'll knock the price down. So you're much better off finding it early yourself and fixing it. And then finally, the process ends with a close, sale and purchase agreement. We're really talking about trade buyers here for private businesses. It could be a quoted business buying a private business. Venture capital and private equity could be for medium-sized businesses, but they really want the management team to stay. That's what they're buying. They're investing rather than taking it over. So we're going to just focus on the trade buyer. Types of sale: you can either sell the bits and pieces of the business, buildings, vehicles, employees, databases, or you can sell the whole thing as a going concern, which is called an equity sale. Most sellers would like an equity sale. Many buyers would like an asset sale, so there's a point of negotiation for you. And the type of deal, rarely nowadays cash, would usually be some kind of payment with an earn out, so stage payments, possibly involving some kind of performance earn out as well. Lots of ways of valuing a business. Some are very complicated. Here are 3 simple ones. Discounted cash flow, which takes your forecast of future earnings, profit, and they will then apply a risk factor to that and bring it back to a value in today's terms of those future cash flows. Asset value is the sort of balance sheet value of the business, the actual value of the stock, the vehicles, the buildings, more or less as if it was a sort of a car boot sale. So it would be a lowish value unless you're perhaps a property business. And market value is the normal way of doing it, or the most common way of doing it. In the quoted world, this is based on the PE ratio, price earnings ratio. You'll see these quoted in the newspapers, talked about when a big deal is going through on the news. For private businesses, you could take the same approach as a multiple of your profits, but you'll get a much lower ratio than you would if it was a quoted business. But ultimately, and the message of this brief video is that a business is worth whatever a buyer thinks it is worth, and it's your job to position it so that's the most it can be, rather than just simply using a methodology based on some numbers. That's it.